Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, January 11th, 2022. It is 12:03 Eastern Time as I'm starting the video. So mid-session update here, and what I'll do is I'll keep this one limited to the broad markets. I can keep the video short, and then I'll follow up with a separate video updating some of the recently highlighted trade ideas, and that'll be Treasury bonds, oil, natural gas, sugar, wheat, let's see, crypto. I want to do Bitcoin and Ethereum, update those guys, and then one more. What was it? Cocoa. So we'll do that. So we have various commodities in the next update, and if there's any individual stocks that stand out. But let's dive into the charts right now and look at the major stock indexes. I'm going to start out on the daily time frames, and I'll hit all three of the majors that I cover: QQQ, SPY, and IWM. And then we'll step down the 60-minute time frame, and then I'm going to look at a few of the market-leading stocks. And starting out here with QQQ daily time frame, here's what happened. We had that previous high right there back from late August, early September. We had a breakout, back test 1, back test 2, and then yesterday we had what appeared to be, at the time certainly was one of the best sell, not one of the best sell signals. Our best sell signals are back here. We're still well off the highs. Correction still very much intact. But that looked to be legit. It was impulsive, everything, and then they stepped in and reversed it right where we expected it, right on T4. We hit T4 to the button on QQQ 60-minute chart. We also hit that support zone on the futures and bounced. And now I want to talk about where we're at today and what we need to look for going forward for both the bull and bearish case. So I'll cover both sides because I know there's always different opinions out there. So on the bearish case, we need to see a move back down. Most importantly now, we need to take out yesterday's lows. But for today, what I'd like to see ideally to keep the bearish case intact is a reversal of this rally so far and to put us back down on or below the trend line right there. And again, because we've now regained that trend line intraday. Now the day's still young. We're only about halfway through the trading session, but as of now we're above the primary trend line, or the trend line that I have coming off the September lows right there. Lots of reactions. So that's what's going on there. And I also ideally want to see us get back below that 377.64. Those were the levels I had highlighted recently. The trend line, and then 377.64 is needing to trigger the next sell signal. Again, we've had sell signals in multiple objective shorting ops. Each and every one of these pushbacks, including these back here in the holidays when we just on low volume went above that 401-ish level, were highlighted as objective short entries, our add-ons. So any way you slice or dice it, all the short entries in the last couple months are still profitable at this point in time. Now, so that's what I want to see. It doesn't help the bearish case that we're back above there. And so here's the easiest way for me to say this. At this point in time, until and unless we fall back down and get back below that uptrend line, or you want to be safe below that 377.64 level right there, I would not add to any shorts at this point in time. Again, if you got them, you got back here, you had good entries, just hold on, wait until you see a move back down, and all the better if and when we take out the recent lows. But I'm also going to give you some other levels and developments we need to see on the other charts as well. So that's QQQ, and we're going to loop back. I'm going to show you some resistance on the market leading stocks right now that you don't see on QQQ. Yeah, at least not on this time frame. Just like yesterday when we hit that low, I showed you that although QQQ, I didn't have any support on the daily chart, I had the top three holdings, Apple, Microsoft, and Alphabet, all at pretty decent support, and that was the case for the to make a bounce trade, cover shorts, and go long for an active trader. But swing traders, I'd still sit tight. Today really hasn't done anything to significantly change the charts. Again, I don't like to see that bounce come back above the trend line. We'll see how the day finishes. But as far as retracements and all that, we're still well below 50% or 61.8% retracement level on the Qs. But let me look at SPY and IWM and tell you what we need to see as well. So remember, QQQ did, as of yesterday, failed that previous breakout in the two back tests that we had, but SPY has not. And although, yes, I trade QQQ, I prefer to trade it over SPY in most instances, not always. Sometimes I'll go to SPY if I think a big drop's coming in the financials, other areas, because you don't have financials in the Nasdaq 100. It's a sector that's pretty much lacking for the most part. But SPY, you have a pretty good weighting. But SPY is still the stock market. This could be, and I'm going to spin it. If you want to spin it as glass half full, meaning you're a bull, an optimist, you say that, the recent weakness in the market has been tech correction. And it has, absolutely. Tech has been hit the hardest, big tech, and FANGs and all that. Glass half empty says when you see the market leaders finally roll over, then that's usually a sign of the top of the market. Whereas glass half full, the bulls will say that it's just isolated. Tech got a little ahead of itself, having a little corrective adjustment, factoring in the rates going up sometime this year, and maybe it's it. Maybe it's a buying up. But again, you guys know my thoughts where I think we're going, and nothing's changed on that longer term. But here's what's going to need to happen for me to go from having a pretty good degree of confidence that we are going to have a 20% or more correction in the market coming up to a very good chance, the odds increase. And that's going to be a failure of this. Again, we had a previous all-time high there back in late August, early September, just like we did on QQQ. SPY, just like QQQ, broke out. SPY, just like QQQ, back-tested it twice. However, the S&P 500 has not back-tested those levels again. And again, I put just like QQQ, I have the line a little bit below the actual breakout point, and I did that, and that's why it's yellow at 450, even though the previous high was about 453.75, give or take. Back test, and this is completely normal. In fact, it's more than common. You don't make always a perfect back test. You undercut it a little bit on both of those two pullbacks right there. And because those are reaction lows right now, that's the level that needs to go. So to make it very simple, nothing's changed here. We had some sell signals, quite a few on the Qs lately, but SPY really needs to take out that yellow line, and that's at 450. And from where we're at right now, as I do the video, that's about another 3.8. Call it 4%, because you're going to need to take it out. It's going to take you 3.8 just to get there from where we're at right now, and you want to see a solid break, especially a solid daily close. If and when that happens, QQQ should be, because it's already lagging, should be below there as well. That would be a massive check mark for me, and that's going to open the door, I think, for the move down to the next targets, the 200-day moving averages, and some of those longer-term targets I gave you. So that's it. So yesterday, really, in the bigger picture, at least this daily chart of SPY had virtually zero impact on a technical perspective. Again, on this time frame, because all we've been in this trading range here. And we were smack in the middle of it yesterday, and we still are right now. But based on everything that I've covered in recent weeks, divergences, market breadth deterioration, sell signals, and breakdowns in the market-leading stocks and the tech-heavy Nasdaq 100, I do think that that's going to happen. And I will say this, that again, I'll point out bullish developments, and I've said it many times, if you're a bull, you can buy these back tests and hold out for new highs and more. Just set your stops somewhat below. Use the same levels that I'm highlighting to add to or increase short exposure, or even take new shorts if you're not already short. You can use those levels as levels that would be objective to stop out of your longs. But let me say this, that any move up to new highs, should this rally continue to go, assuming it does so and we make a new high in either the S&P 500 and or the Nasdaq within the next few weeks or so, it is guaranteed to simply extend the existing negative divergences. So again, it's a new high that I would just put as much odds, if this happens in the next few weeks, that it will fail and ultimately lead to a much bigger drop, as I do right now believe that this was the high, and we're going to do that. So in other words, if that makes sense to you, hopefully it does. This, in other words, this anytime soon won't change the technical picture. Now, should we move around sideways for months? Maybe these indicators are going to look a little different. Maybe the divergence will be gone. Maybe we can say with a pretty good degree of confidence that the in markets have burned off any overbought conditions and excessive bullishness by correcting sideways. I always talk about that. Stock prices, an index, a security, an individual stock can correct in one of two ways. It can correct in time, in price by dropping, or it can correct in time. And so far, this has been, going sideways. It's called a correction in time. We're back to where we were, as of today. We're trading where we were back in the beginning of January. So, a couple months of sideways trading right there. But again, it's the everything else I read in the charts to say the likely scenarios that we will break down sooner than later. And once we do take out that 450, that's where things should get pretty ugly for the market, that is. All right, so that is SPY. You know the levels to watch on QQQ and SPY now. IWM. Again, talk about a sideways trading range. This is one of the biggest I've seen in a major stock index in a long, long time. This goes back to the beginning of beginning of 2021. So for over a year now, the Nasdaq, or I'm sorry, the Russell 2000 Small Cap Index has gone exactly nowhere. We are today right here. We're 216.44. We're trading exactly where we were a year ago. This is the beginning of January right here. And so you want a little higher, you want a little lower, higher, lower. And again, it's super well defined, but based on the divergences, again, we did this when we popped in, put in this failed breakout. We tried to, or the small caps tried to break out, and they did, but then it failed. Break out above that trading range, and that's a bear trap. That's bearish. I'm sorry, a bull trap. Bulls will buy a breakout to new highs. The fact it failed is bearish, and the fact it did so with big negative divergence tells me that chances are when we finally have a definitive resolution from this trading range that it's going to be to the downside. Again, chances are. Nothing's 100% certain in trading. Just like in life, you don't have 100% guarantees on a lot of things, but you can put the odds in your favors, and that's what we're looking at here. But to see it happen, there's the magic number, 2850 right there, just like SPY and the levels we're watching on the Nasdaq 100. That needs to go. Unless that happens, we're just smack inside this trading range. And yeah, we're closer to the bottom now, so that puts, at this very point in time, it puts the risk of a breakdown a lot higher than it does the risk of a breakout, right? Doesn't that make sense? Because we're at 216.47. Let me zoom in here. We're only from the bottom of the range about 3.6%, but to get to the top of the range, not even including that breakout over there, you got to rally about 8%. So there's no risk of a breakout at least anytime soon in the Nasdaq or in the Russell 2000. But there's certainly a risk of a breakdown, especially if we drop just another few percentage points. So that's it. It appears to me that the markets, SPY, especially the S&P 500, Nasdaq 100 as well, and the small caps are sitting on the edge of a technical cliff. And there's your cliff right there. To me, it's as clear as can be. And so that's what we need to see happen to really get things going and to the downside. And if that happens, we're talking a drop of from 208.50 down to my 170 target, which is my sole target. I'm not, there'll be little hiccups certainly along the way, counter trend rallies I'm referring to, but ultimately I think we'll drop about 18.5% or so down to that 170 level in IWM. Okay, now let's step it down, ratchet down to the 60-minute charts. Well, there's then I didn't want to spend too much time on the small caps. They put in that bullish falling wedge recently. It broke out, but then right after the breakout, we put in negative divergence, and we fell back down. Now they could certainly step in here. We're still below that low, or still above that low. We could certainly rally up, but again, let's focus on the big caps right now because they're really going to determine where the market goes. So I showed you levels to watch on SPY on the daily chart. This is what you want to watch on the 60-minute chart. We have that nice clean up trend line I showed you recently, October lows right there, early October lows, major reaction low, another one there, and another one recently. And so far that's held. We're coming off this divergent high right here. Last time we had a divergent high was, well, last one was there. So we had that one, this one, and so far this one. And again, the divergence is much larger on the daily time frame. So that tells me that sooner or later, one of these seemingly innocuous little, divergent highs on the 60-minute chart, which, in the past few months have been good for drops of about 5%, right, from top to bottom, that we're going to get one that's going to be, the big one that takes us down below that support level on the more significant daily chart. So just kind of sum it up here, looking at this 60-minute chart of SPY. The levels to watch right now, obviously, you're going to be that trend line there. Make it easy. Just say on all of them, Nasdaq 100, Russell 2000, SPY, a break of yesterday's lows, because that'll do the trick. If we take out yesterday's lows, we're going to have taken out the trend line as well. Then you have pretty decent support on SPY, about 451.46. That should be roughly in line with that, that key level on the daily chart I told you has to be taken out. Overhead, we still have some pretty significant resistance there, about 470.69, and then 473. Those are my levels on SPY. Now, the one that I'm really focused on the most, QQQ, because so far the Qs and Nasdaq Big Tech is in correction mode, and I think it's got more to come. So you have the same trend line off the early October lows, and you have that distinct reaction there, another reaction here in mid-December there. We danced on it for a few days there, so that's the third reaction. Then we broke down, and now we are back testing it from below. So I've given you a couple objective short levels. I told you yesterday that's where I reversed long when T4 was hit, as well as that support level on the Nasdaq 100 futures. I told you my bounce target zone would be this gap, and that's that box right there. There's the top of the gap, the bottom. I did a follow-up video, follow-up question, or an answer to a question in the comments section in one of the recent posts yesterday, talking about, somebody asked about the gaps, and technically the top of a gap is where you close the previous session, and the bottom of the gap is where you open. Now, I boxed it in, that's not exactly the gap, because you see this is yesterday's candle. The fat part, called the body, shows you where the open and close of the day was, and then the skinny part is called the shadow. The shadow. When it's up top, it's called a wick up here. When it's on the bottom, they call the shadow a tail. And there's your body. So the shadows show you the high and the low for the day. And again, I put back on that. What I was looking at, sometimes I'll just color a gap, even though it's not technically the actual gap. I look at reactions. I like to look at a lot of levels. And what I mentioned to somebody yesterday is you had a lot of reactions just above the actual technical top of the gap, there at about 382. Now we've already punched through there today, and we did it. So that was resistance, but we did it pretty impulsively, and that took us up to, again, now we zoom all the way back out, and you can see that's where we're at. We're at this trend line right now. And let's just, for fun, put up some fibs and see how much we've retraced right here. Fibonacci retracement. Let me go off this reaction high right there. That looks like the most significant one. And you can see we haven't even yet retraced 50%. So it's just a run-of-the-mill kickback rally. Doesn't even start doing any damage to the longer-term bearish trend, at least from a fib perspective, until we take out the 61.8. So we've got room to go. Again, I'm not liking where we're at on the daily chart, but it's certainly not it certainly has not eliminated the bearish case. And if we reverse today, as I think we will, I think we'll probably dump into the close and get back down on or below that trend line. And then if that happens, this is what I need to see. If we can fade the rally over the last 2 days, which again, if you were an active trader, you caught at least a good part of that bounce so far. And I'm back short again. I think we'll get another move down and then hit that next target there around 360. If that happens, it's going to be pretty darn bearish, and I'll show you why. Let me do that now. Because you had, remember, on the 60-minute chart of QQQ and SPY, One thing lacking that would normally get me talking a little bit less bearish right now, or even more bullish. In other words, covered my shorts yesterday, not just for a quick bounce trade to reverse to long, but cover those shorts permanently to reverse back into a swing trade, swing longs that I'm tucking away for a few days or a few weeks. That would have been the case had we had bullish divergence on the 60-minute charts of QQQ and SPY on both the PPO and RSI. As it is now, we only had a divergence on the RSI right there, not even close on the PPO, and as such, and based on everything going on the daily chart, I think we'll get another leg down here soon. But we need to get it. And I tell you right now, you can add, you certainly can add here. But if you're a more conservative or conventional trader, I gotta say they gobbled this up pretty hard so far. The buyers have stepped in where they needed to. But if you want to really increase your odds, again, just wait till yesterday's lows get taken out in QQQ and SPY, and that should, I think it would be a knife through the heart of the bulls. Why? Because you had, as I said, one of the best setups in a while now with positive divergence on the 60-minute chart. Here's my 120-minute chart of NQ, Nasdaq 100 futures right there. That's that level, or that support zone that I mentioned as an objective level to reverse. We had positive divergences, and it's been good for a nice bounce so far. We took out a little downtrend line there. But if this divergence proves or gets sold into with, although it's a decent rally if you're an active trader, not an investor. An investor, all it is so far is what, about 4%. Which again, not bad to play a little bounce trade, but that's not what a typical swing or trend trader is looking for. They're looking for a lot more. They're looking to position for weeks or months on a trade. And now, like I said, this was the most recent divergence. In the past, and I'll get to the 60-minute chart in a second, and I'll show you divergence here. We had much larger rallies. Even if they didn't take us to new highs, they lasted longer, and the divergences played out for much more. So where I'm going, if this gets sold into today, tomorrow, and we do take out those lows, and these divergences fail to pan out, especially if they get taken out by by these indicators moving below those recent lows. Let me roll down to a 30-minute or a 60-minute chart, because I'm on a 120-minute chart now. There it is. This is what it will look like. So you can see previous divergent low right there, the previous one right here. I'll use the yellow line right there, divergent low, right there, divergent low. Of course, you had divergent high there, and divergent high there, and divergent high here. So this is it, kind of back and forth, back and forth. And the takeaway right now, look, we regained that level. That to me was pretty darn bearish when we broke it, but we hit support. And again, as expected, bounced off that support level. And that bounce took us back up above where that's where I reversed back to short. And I'm still sitting tight on that. Yeah, I'm not going to keep adding at this point in time. Again, because that's me, because I already got where I wanted to be. If you took that long yesterday and you decided to just trail a stop up, well, good for you. Because you milked it out for a little bit more. And who knows, maybe it's going to do this. I don't know. I don't think so. But what I would say is at this point in time, maybe tighten your stops up and get ready to reverse back into a short if we fall back below 15,536. That's what you really need to see, a failure back below that level, and then ultimately, again, a break of yesterday's lows. And that to me would be an all-in moment where, all in, not everything in your portfolio, short the Nasdaq 100 or whatever other indexes you want to short, but whatever that allocation is, because in your portfolio you should have other things: gold, silver, treasury bonds, Bitcoin, commodities, and whatever your all in for the equities is. This is someone's portfolio, and you have pieces of the pie. That might be your equity indexes, this might be gold and silver, this might be treasury bonds right now, a little wheat, soybeans, crypto, et cetera, et cetera, et cetera. And that's balanced portfolio. So that's where I'd be looking at to get aggressively long, and again, aggressively short. And again, this is by the 60-minute chart, some of the nicer divergent lows that we've had in a while. and these two took us up quite a bit. This one right now, if you want to call it for what it is, we had a breakdown, and the breakdown failed. We've recovered that level, so you can call that a bear trap, and it's absolutely what it is at this point in time, technically speaking. So the onus is on the bulls to keep it above that level. And they've already back tested it once, but should it fail and we start moving lower, and then we take out these indicators, take out those divergences, that's where I think that waterfall selling will come in. Also, remember the levels I showed you on SPY and IWM, the recent lows. They had a little bit more downside to go, and that's it. That's your all-in moment. That's where I think the odds of a 20+% correction and/or bear market increase substantially if and when those levels get taken out. Okay, so for the case to short here, again, you can layer in. You can layer it in anywhere in the gap. You can layer in here. It's resistance. You know, if you do believe the market's going lower, then it's just, again, it's trading 101. You layer in. Maybe we come all the way up here. There's a downtrend line now that's formed off the highs right there with 1, 2, 3, 4 reactions. And again, that's going to come in right with that key 401 level. So really, anything here I'm okay with. Anything much above there, I'm not. And that's where I start scaling out and stopping out of short positions. So there's a case to be short right now on the trend line. So far as I've started the video, we started to have a reaction. And then I'm going to wrap it up here just showing you some of the market leading stocks. I added a couple levels here. Here's Apple. All right, so remember I gave you last week a sell signal on Apple. I told you it broke this trend line. You had negative divergence right here, bearish rising wedge, and there's your breakdown candle right here, this big red candle, right? And so right now, if you use that, that was your breakdown point. And so I put a line there at 174.88. You also had some support, minor support right there. And basically we've rallied back. So it's a breakdown and a back test of the breakdown point. So case could be made to short Apple right there. If it goes higher, case could also be made if we get to the trend line, although we'd have to do it soon. The problem about shorting back tests on steep trend lines is they're pretty high up, and then if you back test for, let's say, several days, you keep going higher. And then ultimately, there's no guarantee that when you back test, you're going to fall. So that's the problem with shorting a back test to a trend line. But either way, you can always short a back test of a breakout, and that's what that is. That was a breakdown candle right there, and then we are at minor resistance. Microsoft, even better. Microsoft, I had this line here at 317.16. We had a big old gap right there, right? That gap was a breakaway gap. We had an all-time high here, tested. We broke out, but kind of just meandered around and then gapped up. So a little breakaway gap, rallied, back tested it, right? Back tested it perfectly. And so far, so good. The breakout had held until, boom, we broke down. And then we hit. I also had, before we hit it, I had a line here at 305.9. In fact, that's where we were yesterday when I told you there was the breakout itself. And that's where the case to go long for a quick bounce trade, because this is where buyers are going to step in. All trading programs, algos will buy, humans will buy, and that's what they did so far. Now the question is how far. I think it's just a reflexive bounce off that initial tag of 305.90. But look right back into that second yellow line I had at 317.16. So this is an objective short entry. And should we go a little higher, we're going to have the key primary trend line, which was also taken out yesterday. You get a back test of that. Anything much above that, it really just starts chipping away. It doesn't eliminate the bearish case, but it's going to increase the odds that you're going to go to, run at and test and even possibly break out in the new highs. As of now, we're not there. We're not even close. We're still, this is just a little tiny blip about back to where, where it should have gone. And where it goes from here will be telling. So let's see what happens the rest of the day and into tomorrow. Alphabet, last one, because these are the three big ones I focused on yesterday. Had that big key yellow line there, the important level at 26.74. That was also the level highlighted yesterday as a key support level where you can go long. And look, this is what I've added here, 28.06. Why did I add that line there? Well, most importantly, always I give the highest weighting to the most recent reactions. You have some reactions back here, and here, but these are your most recent, and they're very clean. So all this is, at this point in time, there's your breakdown candle, big and red, solid red impulsive candle, high volume, right down through that support. to hit the next support level and bounced. Boom, that's it. So you can make a case to step in short here and add to or initiate shorts. Again, everybody's going to have different positioning. Some of you don't even short. Some of you are like, Randy, just point out your levels. I'm a bull. I want to go long. Well, there it is. You went long yesterday. You're in good hands. Set your stop, raise it. Either set it at your entry point at yesterday's lows or bring it up and trail it up. Maybe allow for another drop down. That's what I would do if you're looking for new highs. It's all about risk return. I talk of active trading, and the active trader only wanted to get 2-3% on the a bounce off there yesterday. You should be out of those longs and back into shorts now. Yeah, that's it. Let's wrap it up here. This video is under 30 minutes. I'm glad I just kept this one to the equity markets, and I'll follow up a little later with some other of those individual stocks. We'll look at gold, crypto, and all the other asset classes. This has been Randy Finney with Right Side of the Chart. Have a great day.